Hi, this is James Ng, and today we're going to talk about top 10 questions I received. I was at a real estate conference this past weekend. It was all virtual, of course, but just want to address where we are in the market today, and then also the top 10 questions I received over the weekend. So just a little bit about my background. I've closed over 1.5 billion in commercial real estate transactions. Half of that really as a loan underwriter at GE Capital from 2007 to 2015. And then the last 5 years really as a loan originator, originating close to 750 million in multifamily loans across 125 properties. In the last 5 years, I've also invested as a limited partner in over 6,000 units across 21 properties in DFW, Austin, and San Antonio. So market update. So I pulled this chart from Marcus and Millichap's webcast last week. It really shows, historical recessions and then their speed to economic recovery. And so it goes all the way back to sort of 73, all the way to the Great Recession. And a couple of things to note here. I thought it was an interesting chart. Number one, the duration of these economic shocks was anywhere from 8 months to 18 months, the longest being the Great Recession. I think we're in month one today, so we might have anywhere from 8 months to 18 months in front of us. And then unemployment. So unemployment on all these recessions essentially went from 4 to 5% all the way up to 10.8%. So 10% looks like that's the breaking point. I mean, unemployment the last 2 weeks, first week was 3.3 million, second week was 6.6 million. That's already 10 million jobs in 2 weeks, and we lost about 8 million in the financial crisis. So we're almost there. So we're gonna, I think once unemployment hits that 10, 11%, hopefully it doesn't drive past that. But in terms of, if you look at the red part, it really talks about how it came back the following 12 months. So, GDP turned positive, jobs turned positive, retail sales increased. And so S&P 500 was up anywhere from 20 to 50% the following 12 months once the recessions ended. So just have to make it through the recession, and then you'll be on the other side of it. A couple updates as well. Marcus Millichap pulled out Moody's on their baseline forecasts. They're looking at negative Q1, Q2, 2020, and then coming out Q3, and then a real acceleration by 2021. Whereas PIMCO, they're forecasting more of a longer U. So they're seeing a sharp decline Q1, Q2. Q3 is still negative for them. And in Q4, it looks like it's sort of neutral, coming back to sort of a positive probably by 2021. And they said, look, these baselines are based off of the pandemic curve, obviously, and then also if there is any default in sort of the highly leveraged cyclical parts of the economy, whether that's airlines, hotels, tourists, there's types of they're going to see a prolonged L, or even if the pandemic curve comes back, they're going to see a spike up and then come back down again. So be careful of that. So an L or W could hit us. In terms of apartments, Marcus and Millichap mentioned a couple things. One, what are operators doing right now is they're really focusing on their leases, looking at their rent roll, figuring out who's out of work, who should be filing for unemployment, making sure that they're collecting rent, which we'll get into in the next chart. But the demand they see is still strong in terms of occupancies. They're working through on the loan side. They mentioned, look, the loans on Fannie and Freddie, the last 3, 4, 5 years, it's really been about the property. And, is it 90% occupied for the last 90 days? Is there a good debt service coverage? And then Fannie and Freddie really gave you the loan. Now there's a huge emphasis on the borrower and their experience, their liquidity, their relationship with the bank is even more. They said probably about 50-50 versus probably before it was, 10 to 20% the borrower, 80% the property. Now it's probably 50-50. Stimulus, PPP, EIDL, unemployment, all that stuff is good for your borrowers, good for your tenants, which will in essence be good for your borrowers, or good for borrowers as they pay the rent, they from these payments. And the question is, how long are these payments going to last? And then in terms of new deals, there's no distressed deals right now. We're just starting to collect rent for April. There's still 1031 buyers. They're just using lower leverage or assumable debt, and they're looking for certainty of cash flow. And they mentioned one deal where the seller even escrowed funds to guarantee occupancy in the first 4 to 5 months after the person closed. So sellers who want to who want to sell, or buyers who really want to buy, they're still happening right now. In terms of April collections, this was, the first week of April, really, April 5th. And these are some of the properties that I'm invested in and just an idea of collections. So I mentioned, Class A, the metro that they're in, and then, where they are in collections. So if you look at sort of the Class A stuff, the first four, they're anywhere from 85 to 90%. So they're almost there, 5 days in. Class B here in DFW, it ranges from about 60% all the way up to 80%. And then Class C is about 65 to 70%. So I did not take into account like if that's sort of a monthly rhythm that these guys are doing. But in terms of dramatic drops, in my forbearance analysis, a lot of properties we forecasted 50, 60% drops in income. We are not seeing that yet. So the April rent collection looks pretty good right now from the deals that I've seen. So top 10 questions that I received this past weekend that we're going to go through range from investing in deals to COVID-19's impact on the Fannie and Freddie process. So let's just jump in and take these one by one. So number one, what items should I be looking at as an LP when reviewing a GP's deal? And so this is definitely a more broader question than the current status. But, some of the things that I look at on the income and expense side, I usually look for about a 50% expense ratio, a little bit lower for Class A, a little bit higher for Class C. I look at the income, T12, T3 versus year one, like how much of a pop are we going to get in that year one income? And then I look at tax reassessments and then insurance to see if it's reasonable. Here in Texas, we're seeing insurance at $450 to $500 a door. And then rent growth and expense growth. Most people are using pretty, 0 to 1% rent growth in today's market, and then maybe hitting 2% thereafter. And expenses are growing anywhere from 2 to 3%. Total return. One of the things that a lot of people look for is cash flow today. So certainty of that cash flow. Because, a lot of deals they thought they were going to sell this year, they're not going to sell this year. So how much can you collect from cash flow versus residual sales? So figuring out what percentage of the deal, the return, total return is coming from cash flow versus the residual sale. Loan details, obviously as a mortgage broker, I see or understand a lot of loan terms. So I want to understand really from LP perspective, when's the loan term coming up and how does that impact me in terms of prepayment penalty? How does that impact me in terms of risk, right? So if I have a bridge loan and it's 3 years, how much equity or how much risk do I have in that deal compared to a long-term Fannie Mae loan where my upside might not be as high, but my downside is protected because I don't have a maturity. Property management company, what's their experience in this market? And then what's their size? How many properties do they have that are close by? How are those properties running? Those are all questions that I typically ask as the lender. Sponsor comp, how are they going to split the profits, right? So is it 80-20, 70-30? And then is it a preferred return to you first? And then depreciation allocation. Are they going to do accelerated depreciation? And then are they going to give their percentage of the depreciation to you, or are they going to keep it for themselves as a GP LP split? All right. Number two, what should buyers be doing during this time of COVID-19? Future acquisitions, I would say, there's limited to no hard money right now. There's financing contingencies. People are putting in 90-day closes with 2 15-day extensions. Brokers, look, stay in front of these brokers. They're going to have deals that pop up. We had a couple of brokers on the call at the conference, and they were talking about, look, maybe it's not new debt right now. Maybe it's loan assumptions time. And staying in front of them, because if sellers need to sell, they're still going to sell right now, but if they don't, it's going to be pushed off. So just be ready Q3, Q4. And then investors, like, what do you communicate to your investors? I would communicate how you're performing on your current assets, right? Tell them how you're prepping for future opportunities so that they have liquidity ready to go if you see a good deal. Number three, so how do I build credibility with a lender right now? So for me, somebody who comes to me pre-qualified or wants to get pre-qualified, I look for their PFS, their resume, their schedule of real estate, have all that stuff ready to go. I'll review it, make sure that you have all your sort of ducks in a row. And then if you want to buy, like if you come to me and you have a $3 million net worth and you want to go buy a 100-unit property that's $10 million, you need other people to sign with you, right? So start building that key principal team so that you know what size deal you can qualify for, and then have those guys ready, because those are the resumes you're going to be submitting. And then I have confidence that you can close that loan. So net worth greater than the loan amount, and then 10% of the loan in post-close liquidity is what you need. Number four, so how do I know it's the right time to buy? Um, this is a tough one, right? So we see that the economic drivers driving us down. When does it pop back up, and then how do we make sure that it's going to run for a while? So a lot of people are looking at sort of price versus replacement costs. So what's my basis in the deal? How do I feel comfortable with that? One deal that one broker announced was like, look, we had loan assumptions where essentially somebody put 25% down or 30% down, and now you're able to assume that loan. It might be 85% of the purchase price. And so you only have to put 10 to 15% down equity. And so that feels a little bit better. So you're always trying to get something for 75 cents, 60 cents on the dollar. And so if you can do that with loan assumptions, that might be a sign that it's the right time. And I like to see GDP growth of 2 consecutive quarters at least. And with this pandemic, it might be 3 consecutive quarters when you know it's the right time. And I just saw an email out from Jonathan Twombly, and he was talking about institutional investors, and they really want a 15% IRR, which is essentially 75% total return over 5 years, or even an 8% cash on cash before they jump back into the market. So determine sort of what your investors, that might be a good survey question to your investors is, what time would you invest, right? So what cash on cash, what hurdles would you want to see before I put a deal in front of you? And how would you feel comfortable parting with your 50, 75, 100,000 at this time? Number five, should I raise a blind pool for the upcoming downturn? Grant Cardone does this. Some of the top institutional investors do this. Essentially, they say, look, we're raising money now. And if you can commit $1 million, $2 million, $3 million with me, then when I'm ready to go and I call you and say, hey, I have a deal in September, then you have to wire in the money. So most people who are doing this are buying larger properties. They have a track record, and they have a larger investor base and probably an institutional investor base. If this is your first, second, or third deal, I don't think investors are going to be willing to commit the money without having that first property under contract. Number six, so what impact is COVID-19 having on income and expenses? I would say net rental, April collections have been pretty good. No increases in rents, but most tenants aren't moving right now, so occupancy should stay pretty flat. Other income, you're not getting the application fees, you're not charging late fees, so that's going to go down. G&A, I've seen some people reduce online advertising just depending how their occupancy is doing, but this might be a time to really ramp up the advertising. If you're at 80, 85% and you need to get to 95%, this is the time to really grab those leases. Payroll, I've seen people reduce leasing and maintenance staff and potentially their hours, right? So if the leasing office is closed or you're only doing emergency repairs and maintenance, that might be a time to reduce it down. Utilities. So this is actually pretty interesting, right? So we had a water conservation company at the conference, and they were talking about how water and sewer is really high right now. Electric's really high because everyone's at home, right? So where most people had gone to work from 8 to 5, now they're at home all the time. So if you are all bills paid, it is very important to be efficient right now. And then maybe people who are all bills paid, think about transitioning out of that at some point. Maybe not right now, but as you roll off, maybe it's more important to transition that to the tenants and have some sort of RUBS program. R&M, we've seen it be lower due to there's not as much turnover and only emergency repairs. Insurance and taxes, we haven't really seen any changes quite yet. Replacement reserves, if you have any projects that you've completed, I would definitely draw these from the lender if it's already done. And then most people, their elective CapEx projects are on hold. Number seven, how has COVID-19 impacted Fannie and Freddie? I would say, look, there's a lot of volatility in interest rates right now. We're seeing Fannie 375 to 425, Freddie 425 to 475. IOs cut back maybe 1 to 2 years, LTVs more at 75%, longer closing times. They're expecting declining property collections, but we haven't seen it quite yet, just with this government stimulus. And this is the big thing, right? So interest reserves. So Fannie's putting 12 months of P&I, taxes, insurance, replacement reserves for any loan over 6 million. So on a $7 million loan here in DFW, it's about 500,000. And then that will be released after 2 quarters of 125 debt service. And then for loans under 6 million, it's 18 months of interest reserve. And then Freddie it just announced this 12 months of debt service, P&I. And then they are also pre-screening Houston, Las Vegas, New Orleans, Orlando. So any cities really with, I would say, oil, and then also tourist concentrations they're being very strict on. And then even bridge lenders have a 12-month interest reserve right now. So I think this is short term, hopefully 3 to 6 months, and then they release off of that. So does forbearance, number 8, does forbearance impact my ability to get loans in the future? I would say while you are in forbearance, you're definitely not getting a Fannie or Freddie loan, because that will come up and they're saying, look, you're struggling right now. Why am I going to give you a new loan that could go down? They want strong borrowers right now, like we talked about. So 50% of the emphasis on you, on the borrower. After forbearance, I mean, the longer and further away we get away from this crisis, I think it will get better. But I think people who have made it through this time without taking forbearance, they're going to get better terms. So pricing waivers, IO, leverage, because I think you're going to still have to disclose this, right? So I think you can explain it away, but you're going to still have to disclose that you put your loan in forbearance and you didn't have the, savings or, cash to maintain yourself. Does applying for PPP or EIDL loan, which is through the SBA, which we talked about last week, impact my existing Fannie Mae loan? So the PPP loan, so these loans are only a week old, so it's still early, but the PPP loan requires no person guarantee or collateral. So it should not impact your Fannie Mae loan. EIDL loan, we're seeing that one requires a personal guarantee and collateral. So if you're applying from your entity standpoint, I would say that one could impact your Fannie Mae loan. But either way, talk to your attorney. Once nobody's actually received any of these loans, so once you get the loan documents, talk with your attorney and figure out if it does impact any of the covenants on the Fannie Mae loan. And number 10, so how do people qualify as a PPP as a multifamily owner? I've seen property management companies with less than 500 employees apply for the program and then have that, those 2.5 months of payroll allocated to the property. Okay. If you're a self-managed owner and then you have a separate management company where a lot of your revenue is just, whether it's fee income from the property, but not rental income, then that potentially could be a way. But at this time, third-party property management companies with over 500 employees, they're not qualifying on the existing PPP. Next step. So if you like this video, definitely like the video, subscribe to the YouTube channel. I really appreciate you guys all out there. Let me know if you have any feedback or any questions. You can reach out to me on my cell phone or email, and then see any loan closings at txmultifamily.com and set up some time to talk with me about any new deals or refinances. Thanks a lot, guys.